Have you ever wondered why some investments are worth more than others, even if they seem similar? It's not just about the return on investment. It's also about when that money comes in. In this video, we'll explore the time value of money TVM, a fundamental concept in finance that can help you make sense of your financial decisions. First, let's talk about what TVM is all about. It's actually quite simple. Money received today is worth more than the same amount received at a later date. This may sound counterintuitive. After all, wouldn't $100 received next year be just as valuable as $100 received today? But think about it this way. If you had $100 today and could invest it at 5% interest, by the end of the year, your money would have grown to around $105. So even though you still only have $100 in total value, having that extra $5 can make a big difference. Now let's get into some specifics about how TVM works. There are several key factors at play here: present value PV, future value V, and the time value of money itself. To illustrate these concepts, imagine you're considering two different investment options, one with a higher return but paid out in 5 years, versus another with a lower return but paid out immediately. The PV is the amount of money that an investment is worth today, while the V is the amount it's expected to grow to by the end of the investment period. To calculate TVM, you need to take into account the interest rate and time frame involved in your investment or loan. This can be done using a simple formula. PV equals VISA 1 plus RN, where R is the annual interest rate and N is the number of years until the money is received. Next, let's talk about some real-world applications of TVM. One common scenario is when you're deciding whether to take out a loan or accept an investment offer from someone else. For example, imagine you could borrow $10,000 at 6% interest and have to repay it in 3 years. Alternatively, imagine your friend offers to lend you the same amount with no interest but asks for a guarantee that you'll pay them back in 5 years. In this case, TVM would suggest that accepting the loan with interest is actually cheaper than taking out a personal loan from your friend. Finally, let's touch on some common misconceptions about TVM. One thing to keep in mind is that it doesn't necessarily mean that early payments are always better or more valuable. For example, if you're considering two different investment options and one has an interest rate of 5% while the other has a higher return but paid out over a longer period, TVM would suggest choosing the option with the higher return. Quick recap: TVM is the idea that money received today is worth more than the same amount received at a later date. It's influenced by factors like present value, future value, and interest rates, and it can help you make informed decisions about investments and loans. So next time you're weighing your options, remember to think about when, not just how much, that money will come in. In conclusion, understanding TVM is a key part of making smart financial choices. By considering the time value of money, you'll be better equipped to navigate complex financial decisions and make more informed choices for yourself and your business. Let's dive deeper into some specific examples of how TVM can be applied in real-world scenarios. For instance, suppose you're a small business owner who needs to decide whether to invest $100,000 in new equipment or use it to pay off outstanding debts with an interest rate of 8%. Using the present value formula, you could calculate the PV of your future cash flows from the investment and compare them to the PV of paying off the debt. If the PV of the investment is higher, then it might make sense to invest in the equipment. Another example would be when considering a salary increase versus a bonus payment. Suppose you're offered a 10% raise, but you could also receive a one-time bonus of $5,000 next year. Using TVM, you could calculate the PV of the raise and compare it to the PV of the bonus. If the PV of the bonus is higher, then taking the bonus might be the better option. In addition to these individual decisions, TVM can also be applied at a larger scale in business strategy. For instance, consider a company that's deciding whether to invest in research and development or use that money to pay off existing debt. By calculating the PV of future cash flows from R&D investments versus paying off debt, the company could make an informed decision about where to allocate its resources. TVM can also be used to evaluate different investment options, such as stocks versus bonds. For example, suppose you're considering investing in a stock with a potential return of 12% per year over 5 years versus a bond with a fixed interest rate of 6%. Using TVM, you could calculate the PV of the future cash flows from each investment and compare them to determine which one is more valuable. One important thing to keep in mind when applying TVM is that it's not always a straightforward calculation. There are many variables at play, including inflation, taxes, and risk. For instance, if you're considering an investment with a high potential return but also a high level of risk, you might need to adjust the discount rate used in your TVM calculations accordingly. In addition to individual decisions, TVM can also be applied to larger-scale financial planning. For example, suppose you're nearing retirement and are trying to decide whether to take out a portion of your 401k savings or leave it invested. Using TVM, you could calculate the PV of future cash flows from leaving the money invested versus taking it out now. This could help you make an informed decision about how to manage your retirement savings. In conclusion, TVM is a powerful tool for making informed financial decisions. By considering not just the amount of money but also when it's received, individuals and businesses can better navigate complex financial scenarios and make more informed choices. Whether it's deciding between a loan or investment offer, evaluating different investment options, or planning for retirement, TVM provides a framework for thinking critically about time and value. In practice, applying TVM involves several key steps. First, identify the present value and future value of your cash flows. Next, determine the discount rate to use in your calculations. Then calculate the PV using the formula PV equals P at 1 plus RN. Finally, compare the results with other options or scenarios to make an informed decision. TVM can also be used to evaluate different financial instruments, such as stocks versus bonds, or loans versus investments. For example, suppose you're considering investing in a stock with a potential return of 12% per year over 5 years versus a bond with a fixed interest rate of 6%. Using TVM, you could calculate the PV of the future cash flows from each investment and compare them to determine which one is more valuable. When applying TVM, it's essential to consider all relevant factors, including inflation, taxes, and risk. For instance, if you're considering an investment with a high potential return but also a high level of risk, you might need to adjust the discount rate used in your TVM calculations accordingly. In addition to individual decisions, TVM can be applied at a larger scale in business strategy. For example, consider a company that's deciding whether to invest in research and development or use that money to pay off existing debt. By calculating the PV of future cash flows from R&D investments versus paying off debt, the company could make an informed decision about where to allocate its resources. The time value of money concept is essential for making smart financial choices, as it takes into account not just the amount of money but also when it's received. By considering TVM in your decision-making process, you'll be better equipped to navigate complex financial scenarios and make more informed choices for yourself and your business.